Well, it is 10 o'clock here on the dot, so we'd like to start today's Farm Office Live. And my name is David Marison, and I will be serving as your moderator here today and part of our teaching panel. But we would like to welcome you. We had a great session on Wednesday evening, and we're back here to repeat the program. And we're seeing people join us today, and even a few came back. So hopefully, you like the music a little better than what we even had Wednesday night. So today's program, we're going to talk about a whole host of topics that have emerged on the federal level, starting with the Consolidated Appropriation Act of 2021. There's lots of details with that bill that was passed in late December, as well as some of the Paycheck Protection Program, things that have come up, as well as do a general tax update because you have just only almost 2 weeks to finish your 1099 NECs, which are a new thing, or actually an old thing, but a new thing for many of us. And we're going to look at some crop budget updates as well as some Ohio legislative updates. So with that, I'd like to introduce your teaching team for today. And from left to right, Diane Shoemaker, who is our OSU Extension Field Specialist in Dairy Production Economics. Barry Ward, the Director of the OSU Income Tax Schools and the Leader for Production Business Management, and Peggy Hall, who is the director of the OSU Agriculture and Resource Law Program, and yours truly, David Marison, Agriculture and Natural Resources Educator in Coshocton County. Just a reminder that today's program is being recorded. So if there's something that you missed and you want to go back and listen to it, it will be on our farm office website. And you can get the slides as well for what we are presenting here this morning at go.osu.edu/farm office live. Also, as far as logistics, we encourage your questions as we move through this morning's program. So you can submit those. You'll notice on your bottom of your panel for your Zoom, there is a Q&A box as well as a chat box. We are asking that you use the Q&A feature to type your questions that you may have. Most of those questions we'll try to address here today. If we don't, then our teaching team will address those individually with you. If you have any additional questions after the program, don't hesitate to drop me an email at marison.2@osu.edu, and I will forward those to our team. And as I said, we'll try to get to a lot of those during today's program. And then at the conclusion at 10:30, when you exit the Zoom meeting, we just hope that you will take part of our evaluation. We get a lot of great input from you as participants about issues and concerns and topics that you would like to see in our next Farm Office Live, which will be in February. So as you exit today's program, there'll be a survey that will pop up in a browser, and it will only take you a couple minutes to respond to that. And we just ask that you will do that for our team. We will appreciate it. So with that, I'm going to give it to our leadoff hitter, and that's Peggy Hall is going to talk about the Consolidated Appropriations Act of 2021, as well as the COVID relief funding for the USDA, some of the things that we'll be talking about, looks like, Peggy, for the next couple months going forward. So Peggy, I'm going to turn it over to you.
Thanks, David, and good morning, everyone. I want to work through a few of the provisions in that huge Consolidated Appropriations Act recently passed by Congress, and I'm going to focus here on the USDA funding provisions in regards to COVID relief. I'll cover as many of those as I can. We don't have a lot of great detail on this yet, and the big question on everyone's minds would be, when does that begin? When will we start seeing those additional direct payments? And the answer is we don't quite know that yet. We've heard some responses that would suggest that after the inauguration, we might start seeing some of those CFAP payments that already have programs established. So those could come much earlier than some of the later programs that I'll tell you about here that are going to be brand new programs that will require some regulatory action. So certainly within the next month or so, we should see something, and then I would expect that to continue. As far as what's in there, we've got a pretty big number of direct assistance funding in there, 11.2 billion, and then there's another 1.8 billion for USDA for other fund purposes, but of significant stimulus there of 11.2 billion that will go directly to producers. So let's take a look at what that involves. We've got CFAP 3 now, round 3 coming, with additional payments for crops. And those payments will be $20 an acre for eligible crops from 2020. So those are the crops that qualified for CFAP 2. So if you did CFAP 2, you'll be getting an additional payment for CFAP 3. Again, not sure what you will need to do to trigger that payment. We'll wait and see what happens there from USDA, but that payment will most likely be in that first group of the price trigger crops, which would include our corn and beans and wheat here in Ohio. And so for all of those acres, $20 an acre. And then also the flat rate crops are covered as well by this payment. So those of you growing alfalfa, some of our small grains, hemp producers, those are going to also be subject to that $20 per acre payment. And you can see what that looks like in the chart there to the right, what the impact will be nationally for those dollars when we look at that $20 an acre. And it's a pretty significant amount of money then going in direct payments for crops. Beyond that, we had some other provisions in the bill for crops. One is that there's some discretion given to USDA to consider different factors that differentiate among prices. So we can look at certified organic or some of our specialized varieties and local markets and adjust accordingly for those crops in other assistance. We have specialty crops. Those are used and determined on a price basis. And so there's language in the bill stating that they can include their crop insurance indemnities and any disaster payments when establishing that sales basis for the specialty crops. And those could be either 2019 or they can completely substitute 2018 sales when calculating what their sales are for CFAP eligibility. There's also another $100 million going into the specialty crop block grant program that provides state funds for state administered grants to specialty crop producers and researchers. And that 100 million is to address some of the negative impacts, problems highlighted by COVID. And then there's also some language in there because of some of the concern and criticism raised from CFAP 1 and 2 that perhaps those payments weren't fairly allocated. Congress included some language saying that USDA did have the discretion to make additional payments under CFAP 1 and 2 in order to try to even out the playing field, and especially to those producers affected by payment limitations. And there's also a limitation that those payments, though, are intended only to cover up to and no more than 80% of loss. There is also provision 2 to extend marketing assistance loans to 12 months. So USDA has the discretion to do that. They're not required to, but they may extend those loans. And then turning to livestock and poultry, I'm going to cover that, and then Diane will come in after me and discuss the dairy provisions. But when we look at livestock and poultry provisions in the law, there's a concerted effort there to address depopulation. As you know, that was a major concern in 2020. And so funds that will address depopulation losses for those who did not have sufficient access to processing facilities, and a limitation that would be up to 80% fair market value of the animals. And also there won't be double payments if a producer did receive some assistance under other programs, state or federal programs for reimbursement for those depopulation costs. There were some funds available for the costs, but not for the animals themselves. We have also additional cattle inventory payments that try again to even out the disbursement of funds to our cattle producers. And you can see here that there will be a formula utilized in order to make those payments for cattle and inventory from that April-May time period as we saw in CFAP 2. And the calculation, when you work through it, comes out to about $63 a head for fed cattle, $25.50 for our feeder cattle. So those payments will be coming along as well. And then contract growers got some money in this latest package, $1 billion given to USDA to determine how to address losses of our contract growers who were largely left out of those previous versions. And that same limitation of 80%, not to extend beyond 80% coverage of their 2020 revenue losses. Now that one I think will take a little time to create the regulations for that program. So that one we're going to see later than some of these others. There's $20 million thrown at USDA for animal disease prevention and response, something that COVID certainly highlighted and raised new concerns, although that's been an ongoing concern for some time, as has been the possibility of our producers not receiving their cash sales funds from the livestock dealers. And so there's now a mandatory trust provision that will go into place. And any livestock dealer that has over $100,000 per year in average purchases will be required to use that statutory trust mechanism to ensure payment to producers for those cash sales of livestock. And there is also a continuation of the mandatory price reporting that's already in effect. They've kind of kicked that can down the road. And instead of deciding what more to do with it, they're just going to continue mandatory price reporting through September of 2021. For marketing and processing, a lot of attention paid in this bill to address some of the problems that we saw with processing access and struggles with marketing. And so there's $60 million for a grant program for those processors who are at that smaller size level, mid-size level, in order to qualify for federal inspection. There will be grant dollars available to help those processors do that, or if they're trying to get into the cooperative interstate shipment program that would allow them to ship their meat beyond state borders. A lot of money going into helping those processors qualify for those. There is also a mandate for a report from USDA on how we can improve the CIS program. And we've got a lot of involvement in Ohio on that, but there are many states that are not involved in the CIS program, and that causes some problems regionally across the country for access to meat. So they've asked USDA to take a look at that CIS program and also to examine some loan and grant programs that can help increase access to meat and avoid some of the problems that we saw early on in COVID. There's $100 million for the local agriculture market program. Some of you may not be familiar with that, but it does provide assistance to local markets and those engaged in local markets. And so there will be some coverage there to address losses to those who were involved in those local markets because of the insufficient processing issue that we've seen. And then looking beyond at some of the other provisions, there will be, no, I shouldn't say there will be payments. They simply gave USDA the authority to make payments. So we don't know if they'll pick up that authority and what they'll do with it. It will have to come out of their other funding. So there's not a tag with this one, but payments to producers of biofuels and biomass for market losses suffered during COVID there. And again, that's discretionary. There's rural broadband payments to reimburse citizens who had to secure rural broadband for education or employment purposes. And those were pretty high costs for some rural citizens. And so there will be some payments there for that. $300 million for fisheries disaster assistance in this latest package. And then another 200, now that says billion, that's not right. That's 200 million for timber harvesting and hauling businesses to cover those losses that they suffered if they were in excess of 10% or more of their gross revenue in 2020. So pretty broad-based assistance here. And then finally, we look at the food purchasing programs. Those will continue. So another 1.5 billion given for that, for distributing and purchasing food. And there's a requirement to try to do a better job of that. So a mandatory review to improve that process that's been put in place. There was a lot of criticism of the food box program. And so Congress is asking USDA to review and improve the program that it does have in place. There's 75 million for nutrition incentive program that provides fresh fruits and vegetables to those at lower income ranges, and then 75 million for training purposes for socially disadvantaged veteran and beginning farmers, again, all related to some of the impacts that we saw from COVID and perhaps weaknesses in some of our markets. And then finally, there was 28 million allocated to deal with farm stress assistance that USDA may have, and we'll decide how to use that. And with that, I will turn it over now to Diane to discuss the dairy programs.
Good morning. So there were a couple sections in this legislation that address dairy. We're going to focus mostly on this subtitle B, which was about supplemental dairy margin coverage. And to just step back a second, in the 2014 Farm Bill, there was a huge change in how USDA worked with the dairy industry. And until that point, we'd had a support price built into our legislation. In the 2014 Farm Bill, that was discontinued, and the focus then became on risk management and an opportunity that was defined as the Dairy Margin Protection Program to protect a margin reflecting the difference between an all milk price and a calculated feed price each month. That was a challenging program. It didn't accomplish what dairy farmers had hoped it would accomplish, but it was the start of a very new concept. And so it continued to be developed over time in the 2018 Farm Bill. It was kind of reworked and became the Dairy Margin Coverage Program. The Bipartisan Budget Act of 2018 made some additional changes. There's some larger margins that are available. The cost for the first 5 million pounds of production is more affordable, and it continues to be tweaked and improved, and that happened here in this legislation as well. And so while it's still called the Dairy Margin Coverage Program, there will be this supplemental coverage program as outlined in this legislation. And it's addressing one of the issues that has continued to be a larger issue as time passes. This program and how a farm can participate at what level of production they can cover is all based on a production history. The program was legislated first in the 2014 Farm Bill, so the production history was established based on the maximum production in calendar year 2011, 2012, or 2013. So it was closer to a farm's actual production in 2014, but as we now are in 2021, farms have increasingly seen maybe a larger gap between what their actual production is and what they can actually participate, the level of participation they can have in the program. If a farm had participated every year since 2015, until 2018, they were subject to an annual bump that reflected increase in national milk production. So it ranged between less than 1% to about 2%. If they had participated since 2018, their production history would be just shy of 6% higher than it had been when it was initially established. And any farmer who perhaps didn't participate in the past, but if they wanted to participate now, Their production history is still based on that initial hire of 2011, 12, or 13. So what this program is outlining is that for farms that had a production history of less than 5 million pounds, and that production level puts farms in tier 1 premium schedule, in that tier 1 premium schedule, which is the more favorable, more affordable premium schedule. And what does 5 million pounds mean? It would be a farm that's milking approximately 200 Holsteins, could be a few more Jerseys at about 25,000 pounds a year. That farm is likely to hit that 5 million pound mark. It could be a smaller herd with larger milk sales. So it's going to be that 2 to 250 cows and under that would be benefiting from this opportunity. So what they're outlining is that a farm that has an established production history of less than 5 million pounds can compare that to the milk marketings they had in 2019. So milk sold in 2019 compared to that production history, and 75% of that difference would be eligible to be covered under this supplemental dairy margin coverage program, up to that 5 million pound level. And of course, that supplemental coverage, any milk that was included in that supplemental coverage would be subject to the premiums for the level of coverage that a farm enrolls into that program. So that is an interesting opportunity for some of our smaller dairy farms. They would need to be enrolled in the program, produce milk in the United States. There was funding indicated, but no specific amount was indicated for the program. The program is for milk for the program is eligible starting here in January, and it extends through the life of this section of the Farm Bill, so through December of 2023. And we don't know how much that program would cost. It depends on who's enrolled and what milk prices do and so forth. So that's one piece. There was $400 million allocated for the dairy donation program, and that was to facilitate the timely donation of eligible dairy products and prevent and minimize food waste. So processors who have excess product that have partnered with a program that can help distribute that can get some funds to help offset distribution and those types of costs. And then the food, farm to food program has been also part of this legislation, another round of that will certainly impact the dairy industry and dairy prices as dairy products are part of that. So some implications for the dairy industry and some opportunities for some smaller farms to do a little bit more risk management.
Okay, I'm assuming you're done, Diane.
Over to you, Barry.
Okay. All right, thanks a lot. It's good to be with all of you this morning, and we're happy that you're with us. I did want to make a comment on David's playlist that you heard leading into the session today. It's, you know, we got to lighten things up a little bit. It's a lot heavier if we're just talking about legislation the whole time, but going from John Denver to OSU marching band, and then I think you had even some Guns N' Roses in there. You have a wide range and taste, David, and well, kudos, I guess, right? So it was interesting, and get a little look into your playlist there. Okay, we're going to continue on, I guess, with discussion on the Consolidated Appropriations Act 2021. And Peggy's already mentioned the scope of this new legislation that was passed just prior to Christmas and signed just after Christmas. And we've had a couple of 3 weeks now to continue to digest this, try to read through it, get all of the important points that that might be relevant to clients throughout Ohio. So we're going to talk about a number of things here in the next 15 or 20 minutes. Peggy's already talked about CFAP 1 or CFAP 3.0, which is the first bullet that I have there. I'll spend most of my time talking about these last three. The Paycheck Protection Program returns, and this is something that is now in our vocabulary, and we have acronyms, many acronyms associated with this, and a number of other programs that were began with the CARES Act, and they've continued throughout 2020 in response to COVID. So we'll talk quite a bit about the Paycheck Protection Program and who might be eligible and who might be newly eligible, and also the ability to have a second draw. So a second draw loan on the Paycheck Protection Program may be something that at least a few of you may be eligible for, or some of your clients. We'll end with talking about the employee retention credits. This is not something that we really focused on too much over the last few months, primarily because businesses had to have a substantial decline in revenues to be eligible for these employee retention credits. The changes in the guidelines, the rules have allowed perhaps a few people to at least look at using employee retention credits now. Okay, as we mentioned, this is a very large bill. This is a bill that included not only COVID relief, but it also helped to continue the government to continue to operate all the way through September 30th of 2021. So the $2.3 trillion bill had $900 billion in COVID relief in it. And that's primarily where we're going to focus, or where we have focused and will continue to focus. The first thing, and this gets all the headlines and will continue to, because this is something that all individuals will receive, and these are the stimulus payments. Or if you want to call them this, the recovery rebates, the economic impact payments. There's a number of terms that are used for these. In 2020, after the CARES Act, these were $1,200 per person. In this follow-up legislation, this Consolidated Appropriations Act, they're $600 for eligible individuals, $1,200 for those folks that are filing a joint return. And then there are credits available for qualifying children, qualifying dependents. One thing that was changed this time is qualifying adult dependents do not qualify for these credits. So previously they did under the CARES Act with those stimulus payments. This time around, they will not. And there are phase outs for filers with higher adjusted gross incomes, just like with the first stimulus payment checks. Okay. They are considered advanced payments of a tax credit on your 2020 tax return. It's not going to be pushed out into 2021 tax return, but they are going to be reconciled on the tax return that you file this winter, spring. So if the amount received is less than what you're eligible for when you're filing your taxes for 2020, you can claim that as a tax credit on that return this summer, or this winter and spring. If the amount is greater, then you're not going to have to pay that back. So in other words, if you had a credit, you file your taxes for 2020, upcoming here in the next few months, and you find, according to that return, that you weren't eligible for that full $600 per person, you don't have to pay that back. So those rules are pretty similar to the last time through the CARES Act and those $1,200 per person stimulus payments. So the rules are essentially the same. Okay, so let's switch gears and talk more about the Paycheck Protection Program. This is something that many businesses took advantage of after the CARES Act, after it was started after the CARES Act. The Paycheck Protection Program now has been extended through the end of March. So eligible business owners can apply for the Paycheck Protection Program. And there are some specific rules for farmers this time around that allow a lot more folks to perhaps be eligible for the first draw PPP loans. So that's one thing that I want to stress. If you have or you haven't taken out a PPP loan, you need to seriously look at this as a consideration. And you need to probably do it fairly quickly. The allocation is pretty substantial. It's 284 billion. However, that's the limitation, and it may run out. We don't know how soon. It may be a few weeks. It may be very quickly after the opening of this. And it has been opened this week to certain community banks, and that definition is available. Most banks aren't going to open until this next Monday, as far as the taking applications. So you can find out, check with your local lender and find out when they are going to be opening up to receive PPP loans. Okay, one of the big changes, qualified self-employed farmers who did not have employees and had less than $100,000 of net income in 2020, or I'm sorry, in 2019, were not originally eligible for that full and maximum PPP loan and then subsequent forgiveness. So it was something that a lot of individuals didn't consider doing. They might not have been eligible for the maximum amount, or they applied for the loan and were planning on receiving forgiveness and tax-free money, essentially, for not up to that full amount of forgiveness. Farmers, the rules have changed with the Consolidated Appropriations Act. Now farmers are able to receive a PPP loan of up to $20,833 based on their gross income in 2019. As long as they have up to $100,000 in gross income, they will be eligible for that full loan forgiveness. So that's the math we've done in previous Farm Office Lives last year in 2020. And there are a lot of publications that are available that will show you how those calculations will work, but essentially it's 2.5 months of this $100,000. It works out to $20,833. So you are eligible for that if you have gross income of up to $100,000. So there are some options. Okay, so this kind of walks us through the different options that you have as a farm business owner, or as a farm business owner at this point. If you have gross Schedule F income of $100,000, again, you're eligible to go ahead and apply, even if you don't have employees. If you don't have employees, the term that are being used is the owner compensation. You can apply for owner compensation. Some banks will require you to perhaps write yourself a check so that you can go through the proper channels for forgiveness. But here are the options. You can, if you haven't received a PPP loan previously, you can apply for a first draw for that first PPP loan based on $100,000 in gross income. If you received a PPP loan and it wasn't the maximum amount of $20,833, you can go back to your bank as long as you haven't been granted forgiveness of that loan. You can go to your bank and ask to increase that loan amount up to the maximum based on qualifying with $100,000 in gross income. So those are the two steps that you can go through if you're interested in that first draw loan. If you have received a first PPP loan and gone through the forgiveness process, been granted forgiveness, there's a possibility that you will qualify for a second draw PPP loan if you're interested. Now, there are some rules, some different rules for that second draw PPP loan, things that will disqualify some farm business owners. Okay, so the rules do change. First draw PPP loans, if you haven't already received one, the primary eligibility is if you have $100,000 in gross income in 2019, or you can increase that first draw loan as long as you haven't been granted forgiveness. Okay, so those are the two main issues on those first draw PPP loans. We'll get to dealing with expenses here in just a moment. But again, you may be eligible for a second draw if you've gone through forgiveness, if you've spent that money according to the rules that are in place, you can apply for a second draw PPP loan. Okay, let's go and explore some other things. Just to reiterate this again, borrowers, if you haven't received forgiveness, you can request an increase in your loan amount, or if they returned all or part of the PPP loan, if you did, or did not take the full amount of the PPP loan to which you were entitled. Okay, so you can increase that amount as long as you haven't gone through the forgiveness process. There's some other new rules, allows borrowers that you can spend it on a wide variety of things, whether it's the first draw or the second draw PPP loan. The primary rule here is that up 60% or more of that loan has to be spent on some type of wages. And then the other 40% can be spent on other allowable covered expenses. And that includes a wide variety of things, and they've increased the amount or the types of expenses that can be covered. So we can look here and we can see we can spend it on business mortgage interest, business rent payments, business utility payments. And then they've increased the number of things that we can spend that other 40% of that PPP loan on, assuming we want to be granted full forgiveness. Now, there's a lot of you out there, or you may have clients that don't have any employees and applied for a PPP loan for that owner forgiveness, what we've termed owner forgiveness. And most of you are going to simply take that full amount as wages, in other words. So there's no real break in 60-40 break that you have to worry about. Some lenders are going to require you to write yourself a check so that there is a paper trail. In other words, it can be pretty simple to go through the forgiveness process, and even that's been simplified, and we'll go over that here in a moment. But it does. For those that have employees and are worried about that 60-40 split and finding coverable expenses that we can use at least part of that loan on, at least this new legislation opens it up, gives us more choices. We also have more flexibility in terms of using a covered period. This new legislation allows us to use anywhere from an 8 to a 24-week period as far as our covered period, that period during which we have to spend the money on those particular expenses, whether it be 60% payroll and 40% other expenses, or the entire amount to ourselves, owner compensation. So the covered period begins on the date the proceeds are dispersed, anywhere from 8 to 24 weeks. Okay, here's a big one. This is one that we've been waiting for since the CARES Act was passed, and we waited all summer and fall and into the winter before the Consolidated Appropriations Act finally clarified this based on what at least Congress said was their intent when they passed the CARES Act. Prior to this, Treasury and the IRS had weighed in and said that those expenses that were paid for from a forgiven PPP loan would not be deductible on your tax return based on prior tax case law. That was pretty typical. But now this new legislation allows you to have both. You can have your cake and eat it too. In other words, you can have this PPP loan forgiven and it is not claimed on your tax return, so it's not income. But at the same time, any expenses that you had that were associated with that forgiven PPP loan, they can be included on the bottom half of your Schedule F as expenses, and they are tax deductible. So we now have the best of both worlds on these PPP loans. So that is good news for many people that were waiting for that. Okay, so that was a big piece of at least the PPP portion of the Consolidated Appropriations Act. All right, now we have also second draw opportunities. As I mentioned already, if you spent your first PPP loan and were granted forgiveness, all is well, then you can apply for a second draw PPP loan. Now, there are some conditions on these, however. All right, same general conditions. And you have to have spent that first PPP loan, but there are some conditions, and the important one here is that the last bullet that I have in this slide. If you have, you're going to have gross receipts in 2020 that were 25% under gross receipts in 2019. So you would have had to have had a decline in gross receipts in 2020 that were 25% or more in either one of the quarters of 2020 or the entire year lumped together. Okay, so you have either to choose from. So if you can find one quarter in 2020 that fell short of 2019 by 25%, that triggers the eligibility for you to be able to apply for a second draw PPP loan. Okay, at least 25% in one of the quarters. One person that I was working with was looking at their CAT tax, the commercial activity tax returns that they have to file for Ohio. That was going to give them a pretty quick and easy look at a quarterly look at their gross receipts, gross income. Well, gross receipts is different than gross income in the definition. So we don't have time to go into the details of this, but gross receipts are different slightly from gross income. We have to include business income, 4797 gain. We also have to include some cost of goods sold in this calculation of gross receipts. It's going to be roughly the same, but there are going to be some differences there. So just because your gross income is 25% less in a quarter or for the whole year doesn't mean that's going to trigger your eligibility. That's beyond the scope of this particular webinar as an overview. If you have some additional questions, you can find some details online, or I'm happy to walk you through how to go through that calculation of gross receipts. You can contact me by email or phone. Okay, so that's the big one. You know, if you want to qualify for that second draw PPP loan, you have to have a shortfall in 2020 of 25% compared to 2019 in one quarter or for the entire year. There is simplified forgiveness now for those loans, those PPP loans that are less than $150,000. It's essentially an affidavit. It's the task given to the Small Business Administration is that it, I believe, has to be a page or less as far as going through the forgiveness process for these PPP loans. If you have a loan less than $150,000, that's going to be the large majority of folks out there that have farm businesses. You do need to retain records, and the details are there in the event of an audit from the Small Business Administration. One thing that was also clarified and was reversed is that if you received an idle advance, and you could receive an idle advance that was tax-free, and it would have been $1,000 per employee that you could have received under the rules of the CARES Act. $1,000 per employee, including yourself as a self-employed individual, and you could also write those any expenses that were paid for by those idle advances. You could write them off as tax deductible. So similar rules. And the one important thing is you don't need to decrease your PPP loan forgiveness based on this idle advance. And this point is what the Consolidated Appropriations Act clarified. You don't need to decrease the amount of your PPP loan forgiveness based on the amount of your idle advance. So that's been reversed. Okay, just clarifying what I just mentioned as far as exclusion from gross income, taxable income, and also the expenses are deductible on these idle advances. Okay, so now we'll switch gears. I haven't seen any comments or questions yet on Paycheck Protection Program. So if you have those, throw those up into the Q&A, or if you have a chat or if you have a comment about it, please include those as well in the chat feature. The employee retention credit, previously under the rules before the Consolidated Appropriations Act, if you had a PPP loan, you weren't eligible for the employee retention credit, and vice versa. So the new rules, the new guidelines under the Consolidated Appropriations Act allows this. So we now can take an employee retention credit even if we have a PPP loan, and it retroactively allows this back to 2020 quarters. All right, it's also extended until the middle of this year, and we can treat those, anything that's eligible. The one thing that I want to clarify, however, even though you're eligible for both, we can't double dip on those wages. So if you have wages that were paid for out of a forgiven PPP loan, those wages are not eligible for the employee retention credit. So it has to be a different subset of wages of that employee that we're using for each of those programs. Qualifications and the actual credit itself. So we have more flexibility here. The employee retention credit, first of all, has been increased from 50% of qualified wages to 70%. And we can take that retention credit and we can simply take that on our payroll returns that we're filing perhaps monthly, quarterly, and we can remove that allocation or that credit from our payroll payments that we would typically make to the government. Okay, so those federal wage statements, those federal payroll taxes that we typically have to deposit on occasion, instead of paying those fully, we can simply back out that portion of the credit and pay only a small fraction of those based on the amount of credits that we might be eligible for. Now, if our credits were to exceed what we typically would pay in payroll taxes on a monthly or quarterly basis, we can file a return to get those returned to us. And that's also a lot more detail than what we have time to go into during this webinar. But if you have questions on that, you can look that up, find that information, or contact me, and I'll be happy to walk you through that. The other thing is now we have more eligibility, $10,000 per employee per quarter, whereas last year under the CARES Act rules, it was only $10,000 per employee per year. And the shortfall in our revenue, our gross receipts, that has been loosened as well. Previously, we had to have a 50% decrease in gross receipts of our business in one particular calendar quarter. Now the rules for 2021, for these 2 quarters upcoming, you only have to have a 20% decrease in gross receipts. So anything less than 80% of gross receipts from a quarter, corresponding quarter in 2019. So those rules, that rule in itself gives a lot more flexibility and also allows a lot more people to be eligible. There are new rules for net operating losses. Farmers have more flexibility than others. We can carry back net operating losses 2 or 5 years, or we can carry those forward. And there is also this temporary allowance for the next 2 years for 100% deduction of business meals. So if you're applying, or if you are granting and paying for business meals for your employees, and you're eligible to do that based on prior guidelines, if it's something that you would typically be eligible for based on prior guidelines of providing business meals to your employees during the course of the year based on need and so on. And oftentimes farmers will have the ability to qualify at certain times of the year, planting, harvest period, when there's a requirement to continue to work through without giving them time off and the need to do that. Now we can provide those meals and get 100% tax deduction, providing that those meals are coming from a restaurant or other food service location. So this is a pretty big business deduction. It's increased 50%. It was 50% prior, now it's 100% for these next 2 years. Okay, I think I'm at the end of my time, David, and I think I'll turn it over to you. Thank you.
Thanks, Barry. I think we're going to continue on the tax theme here, and I would like to present to you some. It's a relatively an issue that's catching a lot of people off guard, and that's the Form 1099 miscellaneous changes that have been made to bring back the Form 1099 NEC. And Barry, I think we have a poll question that we'd like to move to. So if you could pull that poll up and allow people to answer that real quick. So you can answer this question. This will get you up and moving and be able to click your mouse. Are you aware of the IRS changing of reporting, the IRS change of reporting non-employee compensation from the 1099 miscellaneous form to the 1099 NEC form? So you can answer yes, I'm aware of that change, or no, I'm not. And Barry, it looks like we're right on the numbers of what we had on Wednesday evening. We'll give you a few more minutes to engage here, or a few more seconds, I should say, to engage on that poll if you wish. And
If you're not able to see the polling question, you might have a pop-up blocker engaged that you would have to turn off, or you may have a bandwidth issue, or it may be hiding behind another window if you have multiple windows open. These are typical polling question issues that we have just in case.
okay, Barry, I think we'll end that polling, and 56% of the attendees say no, they hadn't heard that, and 44% have. So hopefully as we go through these slides here, you'll be well aware of the change that's been made. And then we'll start off by looking at the old form, the 1099 miscellaneous, and that is where business owners would previously file the non-employee compensation. You're hiring somebody else who's not your employee to do a service. Starting in the year 2020, Form 1099 NEC will be used for this. In the past, it was on the box 7, right there, you can see. And now the new form is the new 1099 NEC form. So this will be listed, your non-employee compensation will be listed in box 1. It should be noted that there was a 1099 NEC form a long time ago, and we have joked about who has enough gray in their hair to remember that up until 1982, this is what the form looked like for non-employee compensation. And that's when, at that time, it was rolled into the 1099 miscellaneous form. So first, when do you report, or when do you have to report on a 1099 NEC? No changes here for what it was on the 1099 miscellaneous form, but if you've met the following 4 conditions, then generally you need to report non-employee compensation now on the form 1099 NEC. So did you make a payment to someone who is not your employee? You made a payment for services in the course of your trade or business, and you made this payment to an individual, a partnership, or an estate. In some cases, it could be a corporation, and you've made payments to the payee of at least $600. So $600 or greater. Now, typically when we look at agriculture and think of non-employee compensation, we would think of some examples of hiring a neighboring farmer to harvest or spray or plant your crops, or maybe some independent contractors such as crop consultants, mechanics, accountants, veterinarians. And it should be noted that if you are paying for parts and materials as part of the service, so let's say I hire someone to do some work on some equipment like a tractor, and then they're going out and buying some of the parts and other things that they need to fix that tractor, and they bill you for both their labor and their parts, then note that both the payment for the labor plus those supplies that they use would be reported on the 1099 NEC. And that is no different than it has been in the past. Now, reporting is needed for payments typically for sole proprietors, LLCs that are reported as sole proprietors in the $600 or more. Generally, payments to a corporation do not require 1099 NEC to be issued. So one very, very important thing for folks to remember is that you should have them fill out a W-9 before you hire them to do the service for you. so that you can know how they are being taxed to see if that you're eligible or you are required to actually file a 1099 NEC. Just one exception, that if it's a corporation, any payments to an attorney over $600 has to be reported regardless of the business entity, whether they're a corporation or not. And notice the one big thing, and this is why the change occurred, is that any non-employee compensation has to be reported back to the recipient and back to the IRS by January 31st of the year. This year, it happens to be that is February 1st because it falls on a weekend, but you are required to furnish that 1099 to both the IRS and the recipient. And that's where we had confusion on the old 1099 miscellaneous form. On the old 1099 miscellaneous form, if it was non-employee compensation, those rules applied. It needed to be to both by the end of January. But if you had other miscellaneous income that was reported on the form, then it didn't need to be reported to the IRS until the end of February, or in some cases in the end of March, not the end of January. So here's the new 1099 miscellaneous form. So you can basically see what they've done, some adjustments on that. So it will look a little bit different to our producers who are used to using this. And quite typically for agriculture, the 1099 miscellaneous is still reported to especially in agriculture, we would think of reporting land rents. So land rents are still in box 1. At least $600, prizes and awards are box 3. If there's medical and health care payments, those are in box 6, and crop insurance proceeds would be reported in box 9. Again, just as I mentioned on the earlier slide, these forms, the 1099 miscellaneous, need to be the recipient by January 31st. So again, here in 2021, that's February 1st. So just like the 1099 NEC. The difference occurs with when is it due to the IRS. If you are filing by paper, it is due by the end of February 28th. Again, in this year, because the way the weekends fall, that is March 1st. And if it's electronically filed, you have until March 31st to file that 1099 miscellaneous. And some other notables, and these are some questions that are asked from time to time about the 1099s, especially NEC. What happens if the independent contractor does not complete a W-9 for you? And your requirements in that situation is to withhold 28% of the payment that you pay them and send that to the IRS. Now, where a lot of people run into snags is they pay for the entire service, they've paid their bill, the independent contractor refuses to give them a W-9. And of course, there's not the chance to withhold that 28% because you've already made that payment. So in those situations, you can work with your tax professional and be issuing the 1099 NEC with a statement refused and then filing that with the IRS. And most of your tax professionals can help you through that situation. Should be noted also that here's a quick look at the 2021 form for NEC, and you already noticed that they've made a tweak already in the 2020 form that we're using currently. Box 2 and 3 are empty, but you can see they've added some wording in box 2. So that form will already be changed as we move into the next tax year. We had a question from Stan, and Stan asked a great question about, he mentioned that there were some folks, some producers that may have checked into getting some of the 1099 miscellaneous and the 1099 NEC forms from the IRS. You can contact them and go on, and I'll drop those into the chat box as we move into the next section of this presentation. But you can contact the IRS and have them mailed to you. Diane was very efficient for their farm business. She had gotten those mailed to her already, and she did some checking for us here at the beginning. It looks like it's a 10-day out. So with 10 days and the way the mail is, you probably won't get those from the IRS, but you can go on the IRS website and download those. As well as you can go to a lot of your office supply stores. And I believe, Diane, correct me if I'm wrong, but I think you checked Staples. Staples has the 1099 miscellaneous form, but they don't have the 1099 NEC forms, but if you're going to someplace like Office Max still has both of those forms available that you can go into those stores and buy. So you probably check them online and order those, or you can walk into your neighboring store and get those. Diane, did I say that correctly or did I say it backwards?
Backwards.
All right, so correct me.
Staples has NECs, but not miscellaneous.
Okay, so Staples has one, not both, where Office Max has both.
Just both. Yep.
Okay, so you call ahead, check on their websites, and you'll be able to get those. So you only have until the end of this month, January 31st, to get both of those forms back to the providers that you need to get those back to. Just know if you're not doing that on a timely manner, there can be penalties that occur.
I was just going to chime in with one.
Yeah, go ahead, Barry.
Oftentimes, local tax preparers and your CPAs and your local communities will have extras. So you might check there too. I know I've gotten some from a local tax practitioner, and they're willing to, if you're a client, they'll give you those, but they'll have those that they'll probably part with for a small fee as well.
Okay, so that's a great suggestion from Barry. Maybe some local folks, accountants and tax providers in your area might have some of those as well. Just so when we talk about the 1099 NEC, there's no changes as far as the reporting requirement, our obligation to report those folks that we're hiring for services. The only difference that you should be aware of is that they've changed the forms. So just a couple tweaks. Most of our tax providers out across the state of Ohio already are well aware of this and will be behind the scenes helping you with that. And we do get some questions, and outside of the 1099 NEC and 1099 miscellaneous, one of the things that we talked about at tax school this year is we've had some questions from farmers, like we've gotten some of this income that is maybe unusual to us in our farming operation, and how would it be taxed? Some farmers have been asking, can we defer these payments? Well, in this chart that we've made up here, the Farm Bill payment programs, and the first line, those were payments that farmers might have received here in October of 2020 for the 2019 year in the Farm Bill for ARC and PLC. Those, as well as some producers might have applied and got a WIP, which is a WIP plus payment, which is Wildlife and Hurricane Indemnity Program Plus, for some losses that occurred in 2018 and 2019. So any of those traditional Farm Bill program payments that they've got would be claimed in the year that they received the income. So in most cases, those payments received, not in most cases, in all cases, when those were received in 2020, they'll be on the 2020 tax form. And then some producers may have received some EQIP, Environmental Quality Incentives Program payment. Again, those are claimed in the year received. And the big boy is a lot of farmers have received some money from the CFAP, the Corona Food Assistance Program. And that is technically a disaster payment similar to crop insurance. So that's why some people have questioned whether it can be deferred like crop insurance sometimes can. But there is a clear answer to this. And the clear answer is no, it must be claimed in the year received, because the payments were not because of crop damage. They were made because of price and price risk. So CFAP, since it's price based, it's going to be treated just like those ag program payments in line 1, meaning that they are received and they taxed in the year that they are received. Now, we also listed prevented planting indemnity, and that's hard. That's a hard word to say. Prevented plant payments in 2020. The election to defer that recognition of income is an all or nothing election, and it can only be done if you have a history of marketing 50% of your crops, normally in the year after harvest. And then also, of course, the revenue insurance payments. We've talked about this for the last couple of years about, can I defer revenue payments? Just remember that the portion due to low prices must be claimed if you're going to try to go into a deferral. Again, there are a lot of qualifications for you to do that, but the amount that was there because of revenue, because of low prices, must be claimed in the year received. The portion of that revenue insurance payment that was received because of low yields has the potential to be deferred until the next year. And of course, we would just recommend on any of these, as you get into some of these questions on that you just seek guidance with your tax professional. So with that, I believe, Barry, you're going to pick up here, and we're going to completely shift gear away from taxes, away from federal programs, and go to crop budget outlooks.
That's right, David. Thank you. A good review of all the different things that we need to be aware of for tax preparation. Okay, yeah, we're going to talk a little bit about what we expect this year as far as looking forward into 2021 and looking further ahead into the harvest period and where we're going to be perhaps with returns, profit margins for 2021 crops. And that's something that, of course, it's difficult to suss out all the different details at this point, but we have seen enough change in markets that we have seen significant increases in the prospects for profitability for 2021. I think it's useful, though, to go back and look at what we're probably going to see as far as an ending net farm income for 2021. And this big graph, I know this is really busy, but this big graph here on the right, this is the USDA, the Economic Research Service, their estimates and their expectations for the end of 2020 and net farm income for the entire US farm sector. And you can see that compared to 2019, here's where we are in 2019, if you follow my arrow, and a pretty significant jump upwards. Now, this doesn't mean that all sectors are going to see significant increases in income in 2020 compared to where they were in 2019. We know that, right? There are certain sectors that experienced pretty harsh conditions, and even with CFAP payments, didn't fare too well. However, there's a lot of folks that did do better than what we expected, especially about this first quarter, through the first quarter of this last year. And that shows up in USDA estimates in the prior periods. And we go back to these graphs on the left-hand side. If we look at this upper left-hand graph, this is the USDA estimates going back to February 5th. So before COVID really hit, the expectations were that farm profitability, net farm income, was going to be flat to lower, depending on whether we're looking at cash or an accrual-based farm income. So the expectations were mild or bleak at that point. We fast forward to September the 2nd, and we had already come through the CARES Act, and we had started to receive some ad hoc government program payments. And at that point, at least, we had gone through August, and the market prices of most of our major commodity crops, that outlook, those prospects had improved quite a bit. So the improvement in their expectation for profitability in September, and then we fast forward to December, which was now a month and a half ago when their estimates were made. So the outlook for 2021 then follows from this particular estimate for what the end of 2020 looked like. So profitability for some it was substantial increases in profitability in 2020. So what's it look like as we look forward into 2021, given today's conditions? And this is just a snapshot of some of the front pages of our enterprise budgets. These are our crop budgets. You can download these off of our Farm Office website. These are Excel files that you can use to generate your own numbers if you so choose. And that's what we recommend, of course, is using ours as a starting point, but making sure that you start to put in some of your own numbers as you plan for the rest of this year, the rest of 2021. So we're going to look at specifics, and we'll look at corn, soybeans, and wheat and do some comparisons. Effectively, we're looking at a cash price this fall delivery of corn, somewhere around 4.25 right now. And we can lock that in many markets throughout Ohio. This is the trend yield, 175 bushel corn. We go down here and look at profitability then. Returns above variable costs, about $340. We're looking at returns to land of $166. And we look at the high yield scenarios, and of course, they're going to be much better. We've got a higher yield scenario in many parts of Ohio. We compare that to soybeans, and here's where the big change has been. Soybeans, we can lock in somewhere around 11.30, 11.40 per bushel for fall delivery of soybeans right now. So that's new crop beans. And trend yields of 54, higher yield scenarios and environments. We look at the 65 in this column, but returns are pretty positive. These are substantial. These are enough, these are going to be probably calling for more soybean acres throughout Ohio, at least if this ratio of market prices holds where it is right now. Returns to land pretty substantial as well. And then of course the higher yield environments looking better. And then we look at wheat. We look at about 6 1/4 summer delivery of wheat at 72 bushel trend yield for Ohio. And your costs are going to be different. Our cost structure, we put this together based on what we consider a typical farm in Ohio. It's not going to be your farm numbers. So do your own calculations, go through your own budgeting process, but returns above variable costs, you can see trend line wheat also not bad, especially if we compare and we go back to early August and look at the outlook for prices at that point. We've had a lot of changes in fundamentals. USDA reports came out just this last Tuesday, and we're also fairly bullish, fairly low stocks, a lot of usage, and a little less, well, in the case of corn, substantially less of a yield than what was expected in months prior. So bullish signals, increases in prices compared to even where we were at already high prices. We look at the comparison. So we look at the three side by side, try to evaluate based on our best estimates of cost structure, market prices, what's being given right now. And we look at the board, we look at different cash market prices around the state of Ohio. And soybeans, we can see, we look at returns above variable costs, $400 compared to around $340 for corn and $275 for wheat. So soybeans still continues to be a bit of a leader in terms of profitability outlook for 2021, and somewhat of a market signal for considering it for more acres. And I think we'll probably see that play out as we go through the spring and we start to see planting intentions reports come out. A lot can change between now and March, however. We look at those high yield scenarios and the comparisons are much the same. For $500 plus for soybeans, $450 for corn, and for wheat, $350. So the wheat yields the returns, that doesn't include any straw or double crop returns. So that can look substantially better depending on whether or not you're going to include some of these other returns, other receipts to your wheat enterprise. Planting any kind of double crop soybeans can substantially improve that wheat outlook. Switching gears then, and I guess somewhat in the same vein, looking at how farmland values and cash rents may be impacted in 2021 based on not only what happened in 20, but also what our expectations are for crop returns and other fundamental changes as we look into 2021. One thing that typically gets pointed out, and rightfully so, is the impact of these lower interest rates and continued solid fundamentals on land values. And we've seen, at least anecdotally, over the last 3 or 4 months, those auctions that have taken place have been, in most cases, probably surprising on the high side. So that's something that we expected, especially with some of the government infusion of dollars into the farm sector, along with the continued low interest rates, along with the expectations and the market prices being higher into the fall, and the outlook for 2021 being a little bit brighter. So I've got all these kind of stacked up here on the left-hand side as far as the supportive fundamentals, and I think they certainly outweigh those on the right, the ones that perhaps might provide a little downward pressure. And for both values and rents, I think the expectation is, and it should be, into these 4 quarters of 2021, is that there are going to be upward pressure on land values, rents. You know, what's the percentage number? That's always difficult to tell, and it's going to vary by regions of the state. But I think with the farm income being up in 2020, equity positions not terrible and going to be improving in 2021 likely. This third bullet I think is very important. With these run up in prices, outlook has improved, disposition of many farmers have improved. And I think with the relative low supply of land still, so not a lot of land entering the sales market, we're going to see upward pressure. I wouldn't be surprised if it was 3 to 5% higher in 2021. And in some markets, it might be even higher than that, especially for that top ground. Okay, similar on rents. You know, the one thing that stands out and continues to be considered, of course, especially during the big run up that we had in property taxes a few years ago, is how is that impacting rental rates? And that we've seen a lot of relief there, and those CAUV values have declined, and the property taxes associated with those have declined as well. So that is not as big of a fundamental pressure point that it was 4 and 5 and 6 years ago. That was a lot on landowners' minds, but it's still kind of lurking back there. I know some landowners perhaps still use that as a negotiating point, but essentially the fundamentals are the same. And rental rates, I think, will come under pressure. However, there may not be quite the pressure due to the fact that farmers will be pretty reluctant, especially not knowing what 2022 will look like. And likely we're not going to have any or very few ad hoc payments in 2021 other than CFAP 3. Okay, one last thing that I'll mention is the Ohio Farm custom rates that we do every other year. That summary is out, that survey summary. So if you're interested in looking at our latest custom rates, those are available on the Farm Office site. You can find those pretty easy. So with that, I'll turn it back over, I think this time to Peggy. It's all yours. You're muted.
Sorry, I forgot to unmute. Thanks, Barry, for all that information. Every time I listen to you, I pick up something new from that. So always helpful. But now let's turn to legislation. I want to alert you to a few things that recently went through down at our own state house. So turning from federal to state law here and examining a few of the late session bills that did pass. I'm always disappointed with what doesn't get through, but hopefully some of those that we were watching this session will come back next session. We're now in a new 2-year session. So those bills we were watching have expired that didn't get through, but here are a few that did make it. First is the water quality bill, and you can see we've written a post on that on our blog, which is on farmoffice.osu.edu. You can read our blog posts there, and we've been slowly covering the new legislation and informing you on what's in those bills that did get through. So the water quality bill is one that took forever. It was introduced pretty early in the session, but finally went through, and it establishes a watershed planning and management program. Now this legislation aligns very closely with Governor DeWine's H2 Ohio initiative that is already existing and up and running, and many parts of which are being implemented at ODA. And so this one creates a watershed planning and management program, as well as a watershed pilot program that will align with those existing programs. And again, emphasize the need for a very organized and concerted effort toward examining water quality issues, doing planning, providing funding to producers who participate in nutrient management practices, enhancing and reiterating the intent to put resources toward the certification program that is now up and running in Northwestern Ohio and will be expanded around the state. So there's a lot going on in this bill that builds upon what we've begun to do over in that H2 Ohio initiative. One really important provision, though, is that it explicitly exempts nutrient management plans from public record requests. So that's something that I know many producers I've talked to have been concerned about. If I have a plan, is it going to be open to the public and public scrutiny? And this legislation now answers that question with, well, they can't obtain it through a public records request. And then there's some strange little provisions in there as well that ensures CAUV eligibility for biofuel production, not really a water quality issue, but it's in there. Also on the water subject, I was happy to see that House Bill 340 finally went through. That was a 6-year effort by a number of us on the Petition Ditch Task Force that worked on that. And what we've done in that bill that will be effective in March is to try to streamline the 2 different processes for petition ditches in Ohio. We have the county engineer process and the Soil and Water Conservation District process. And those are going to look much more similar now, remove some of that confusion and technical differences that we were seeing between those 2 programs. And the bill also clarifies what happens in a multi-county ditch situation. We do have a chapter of law on that, but there were some problems with counties interpreting that chapter differently. So we've tried to address that. We have increased, and this is one that will affect new projects going forward, the sod and seeded strips for those projects will now increase from 4 to 10 feet as the minimum. 10 to 15 feet wide is the authorization given for those sod and seeded strips. And then all of that acreage is to be removed from the taxable value of land for property tax purposes. And we've also tried to clean up that language when determining assessments, how assessments will be calculated. We've included some specificity and more guidance there in that determination. So that will be coming in March, and hopefully we can get our counties prepared for dealing with the new legislation. There's also a new Ohio Revised Limited Liability Company Act that was passed. That one will not actually take place until next January. So that gives us a year to figure it out and sort through it. Completely revised our LLC laws, which have not been revised at all since they first went into effect in 1994. So just to alert you to some of the most important changes in that package, which is it's a large and somewhat tedious package. It's going to eliminate the distinction between member managed and manager managed LLCs and just have one standard for all of for whether it's either, it doesn't matter. The authority issue will be the same for those, and there'll be some fiduciary duties and standards of conduct that will all be consistent. And that's caused some problems over the years and some litigation as well and confusion. So that will be cleaned up. And then importantly, it puts Ohio as one of the few states now in the country that authorizes series LLCs. And this is something that we use a lot in agriculture, where we have multiple LLCs dealing with different parts of the operation. And in this case now, we will be able to file one kind of parent LLC and then have those different assets separated as a series of assets with similar ownership, not exactly, it doesn't have to be the same ownership. And then we can do our filings all under that parent LLC. So that will remove a lot of the administrative burdens and costs and confusion around one entity, one set of owners or similar owners having all these various LLCs in different places. They can now all be under and listed as a series LLC. So that's exciting. I think we'll see some use of that in agriculture. There's also legislation that allows B corporations now in Ohio, and this one took a while to get through. We've been working on this for about 7 years, I think, in Ohio. So they will be authorized effective March 24th. A B corporation is a for-profit corporation that can now, in its bylaws, say that we have these beneficial purposes along with our other purposes for which we are organized. And so existing corporations can amend their bylaws to allow for those beneficial purposes. And why that's important is because that now becomes part of that corporation's goals, their interests, their derivative actions can all be based upon what, but we're also trying to create and accomplish these beneficial interests. And you can see there what those are considered to be, those kind of social issues, social agendas, having positive effects on some of those issues that you see there. Now, the reason this is so important is because it allows those corporations now to attract more investors who do have these social issues as a priority. And they now can see that this corporation has included this within its bylaws. This is clearly an important purpose and goal of this corporation. So the intent there is to increase investment in many of Ohio's corporations who are already doing some of these things, but can now formalize it and assure investors. And you'll see also that there is some liability protection in regards to those beneficial purposes. So you can read about those on the blog. And now I will turn it over to Diane to talk a little bit about our financial analysis program that she runs. Diane?
Thanks, Peggy. So it is the end of the year when most farms are working on compiling their information and getting that ready to do their income taxes. But it's also the time of year when farms should be looking at a really good analysis of that production year. Where did they make money? Where did they make money? Where did they not? The purpose of our Ohio Farm Business Analysis and Benchmarking Program is to help Ohio's farm families achieve financial success. And so there's a couple opportunities there. The first thing a farm would participate in is what we call a whole farm analysis, and that will give them that accrual adjusted income statement for their farm business, beginning and ending balance sheets, accrual adjusted income statement. So we're pulling all the income and all the expenses of 2020 into that analysis, regardless of what we might have done to manage for income tax purposes, or if we weren't able to get everything paid in a particular year. So that whole farm analysis helps answer that question, was I profitable? And not just on a cash basis, but on a net farm income basis, and also calculates for the farms, the farm financial standards that are industry standards on financial measures and things we can benchmark other businesses against. So that is part of that whole farm analysis. Farms that do that whole farm analysis frequently say, okay, now how can I do better? You know, how can I meet some of my financial and personal goals that are related to the financial success of my business? And that's where this second piece, doing an enterprise analysis, is really critical. And we look at what are the income, what are the expenses for each enterprise. And so bottom line, we know if they make money on an enterprise basis, but also what are those costs of production for corn, beans, dairy cows, beef cattle, whatever that those enterprises happen to be on a farm. So those costs of production for crops will be available per acre and per bushel, hundredweight, ton, whatever the measure happens to be. For whole farm, financial benchmark reports are available, and for those who have crops and livestock, personalized benchmark reports are available. And so that allows a farm to compare individual enterprises, how they perform compared to other farms in Ohio. Each farm's individual information is kept confidential, but we can generate some reports that allow you to look at how you compared to other farms. And then there's annual summaries that are also available for use by farms who aren't participating in the program, or industry personnel who want to get a feel for what some of the numbers are in Ohio. So now is the time to get started on this program. We have a fabulous team of technicians located around the state. You can see we run the program out of Mahoning County, and we have two really excellent folks up there. And then the green counties show where our technicians are housed, but they work across the state. So you don't have to have a technician in your county or near your county. We work with farms across the state, and we can do that personally, in person to some extent. And we also can do a lot of communication in other ways. So we don't have to be right next door. So feel free to contact any of these technicians or Clint Schrader, who's an educator over in Allen County, but is also very active in the Farm Business Analysis Program. To get more information about the program, you can contact myself or any of the folks here. And you can also visit our website. You can get to us through farmoffice.osu.edu or directly at farmprofitability.osu.edu. We are, fortunately this year, still supported by a USDA NIFA grant that allows us to offer this program for $100 a farm, which is a tremendous savings of a good $1,000. So an ongoing program that any farm is more than welcome to do, and we'd love to talk to you about it. The things you get ready for your farm income tax work are things that you will also use to do this. So it's a good thing to tag team. David, back to you.
Great, thanks, Diane. I appreciate everybody joining us today. There's still some time. We're going to hang around as a team to answer your questions. But as we exit, just a reminder that there'll be a survey, post survey that will pop up in a browser for you to answer. Just a few quick questions for us. Some other opportunities in the farm management realm that might interest you. On February 25th, our Farm Bill team will be doing their next ARC PLC meeting, making that 2021 decision. And then also there'll be one on corn and soybean crop insurance considerations on March 8th. You can just register for those programs at go.osu.edu/ARC PLC 2021. OSU Extension is collaborating with AED this year again for some climate and grain market outlooks. Ben Brown and Aaron Wilson will be offering those on January 22nd, February 19th, and March 11th. I know that Ben's moved on to the University of Missouri, but he's still collaborating with Ohio State on a few programs this winter. So we're glad to have Ben providing a marketing outlook, and as well as our own Aaron Wilson with a climate update on those dates. And you can check those out, as well as we would encourage you, if you're thinking about the future of your farm business, our farm succession workshop, Planning for the Future of Your Farm webinar series will be held on February 15th, the 22nd, and March 1st in the evening from 6:30 to 8:30. You can go to that go.osu.edu/farm succession to put in your registration. There is a $40 per family fee for that. And then finally, our next Farm Office Live will be back. We're going to do these monthly, 2 programs each month on the same week, trying to do one in the evening and one during the day to try to meet different folks' schedules. So the next one will be on February 10th, as well as on February 12th. And you can register for either of those programs at go.osu.edu/Farm Office Live. And with that, again, just a reminder, the short survey will pop up when you exit the meeting. I'm going to stop my share and bring all the panelists back together. And folks, thank you, Diane and Barry and Peggy, for your teaching. Are there any items in the chat box or in the Q&A? All right, well, we appreciate everybody attending. Again, go to farmoffice.osu.edu. You can check out the recording if you want to download the slides. You're more than welcome to do that. Thank you and have a great weekend.